What are cryptocurrencies? In basic terms, a cryptocurrency is a medium for exchange online. A cryptocurrency has a number of cryptographical functions which are there to support financial transactions. Most cryptocurrencies use the blockchain technology platform, more on this a little later, as it offers immutability, transparency and decentralization. Cryptocurrencies are not controlled by any central powers, not yet at least. This is deliberate because the whole idea of cryptocurrency and Bitcoin is that they provide immunity from government interference and control. A cryptocurrency can be transferred from one person to another by using public and private keys. There are minimal processing fees involved with cryptocurrency transactions which are part of their appeal. Usually financial institutions have high charges for any monetary transaction. Cryptocurrencies were invented by accident. The inventor of Bitcoin, Satoshi Nakamoto, created a peer-to-peer electronic cash system, and Bitcoin was a byproduct of this system. Before this, there had been numerous attempts to create a digital cash system, but all had failed. The key to the success of Nakamoto's system was that it provided a decentralized financial network rather than the established centralized system. If you wanted to set up your own digital cash system, you would need to create a payment network that provided three key things. 1. Accounts. 2. Balances. 3. Transactions. A problem that all payment networks face is double spending. This is all about preventing spending the same amount twice. Up until the creation of Nakamoto's system, this had always been achieved using central server balance records. This is still in existence today. With a decentralized payment network, there is no central server. Instead, every single network entity or node has to perform its job properly. They all need to have a list of transactions so they can monitor if future transactions are at double spend or valid. All of the peers of a decentralized payment network have to agree on everything. There has to be complete consensus. If this doesn't happen, then the transaction will not take place. The problem was how to achieve this total consensus without a central server. Nakamoto figured this out. The transaction properties of cryptocurrencies. In order for a cryptocurrency system to work effectively, there has to be a number of properties in place. These are immutable. After a cryptocurrency transaction is confirmed, then it cannot be changed. Nobody in the world can change a cryptocurrency transaction, not even presidents or monarchs. It is an immutable record. Basically, if you send money to someone else, that's it. There is no turning back. So if you make a mistake or get scammed, then you are stuck with the situation. You do not have the opportunity to reverse the transaction. Pseudonymous cryptocurrency accounts and transactions have no connection to real-world identities. You will receive a Bitcoin on an address which is a randomly seeming chain of about 30 characters. You can analyze the transaction flow, but you can't usually connect the transaction to a real person through the address. Global transactions at speed. It doesn't take long to propagate transactions and confirm them. Usually this all takes place in minutes. The network for cryptocurrency transactions is global, so it doesn't matter where the transaction originates and terminates. High security. The highest levels of transaction security are essential for a cryptocurrency network, and to this end all funds are locked in a public key cryptography system. Only someone that has a private key can send cryptocurrency. This makes the system extremely secure. No permissions. A cryptocurrency system is a permissionless system. You do not require the permission of anyone or any authority to make a cryptocurrency transaction. There is no gatekeeper with a cryptocurrency system. The monetary properties of cryptocurrency. Now you know the transaction properties of cryptocurrency, you need to understand the monetary properties. These are: there is a controlled supply. Most cryptocurrencies have a limit on the number of tokens supplied. Taking Bitcoin as an example, there will be a decrease of supply over time, and experts estimate that the final number of Bitcoin tokens will happen around 2140. Experts say that only 21 million Bitcoins will be the limit. To control the supply of cryptocurrency tokens, a schedule is written in the underlying code. Using this code, you can approximately calculate today the monetary supply of a cryptocurrency for any given future date. Bearer not debt. With conventional or fiat money underwritten by a government, the bank account you hold is created by debt. All of the entries in your account are debts. It is really an IOU system. A cryptocurrency is not a debt. There has been a lot of controversy over the launch of cryptocurrencies because they are a direct attack on the monetary policy of most nations. Governments or central banks cannot change cryptocurrencies. Therefore, they are immune to inflation and deflation caused by the manipulation of the monetary supply.